Hello guys, welcome to my YouTube channel. Welcome to my channel, and today I'll be showing you how the market moves from one low to a high and from a high to a low. So when we started as traders or as newbies in the market, we're being told from what we've read or videos we've seen, we're being told the price move from a higher high to a higher low, then to a higher high to a higher low, higher highs, higher lows. So basically, this was what we're being taught. The price moved from a higher high to higher low, higher highs to higher lows, and also, and this is for a bullish scenario. This is a bullish scenario, and in a bearish scenario, it will be a lower high to a lower low, a lower high to a lower low, a lower high to a lower low. So this was what we're being told, that that's how the market moves. But now I'm going to show you something not entirely different, but it tends to give you more clarity, because if you keep following this method, higher highs, higher lows, higher highs, higher lows, there are some scenarios where you get lost and you don't know what the market is doing at the moment. So an easier way for you to know what is happening in the market is with this, which I'll be explaining. Let me start by saying I'll be discussing about the element of price. Let me type it out. The element of price. And for this element of price, there are four things that happen with price, or let's say with candlestick. Four things happen, but only one of them happen at a time. So we have four things that happens in the market, but only one can happen at a time. And outside of these four things, market doesn't do anything. These are the only four things that market will do, no matter the pair, no matter if it is stocks or any other market. So far as it's the financial market, these are the four things price will always do. Nothing outside these four. So the first one I'll be explaining, in a bullish scenario, this is an expansion. Yes, this move is an expansion. The second one we are going to have is a retracement. This is a retracement. This is a retracement. The third one we are going to be having is what we call a reversal. It's a reversal. And the fourth one, which is the last one, is what we call consolidation. So we have consolidation. These are the only four things market does. Nothing else outside these four. So the first one is an expansion. An expansion. This is a retracement. This right here is gonna be a reversal. And the last one is going to be consolidation. So these are the four things: expansion, retracement, reversal, and consolidation. And for this expansion, this one I've drawn right here are for bullish scenario. Let's say market is moving to the upside. This is for the bullish scenario. Let me draw for the bearish scenario now. For the expansion, in a bearish scenario where we have price going to the downside, it's going to be like this. Yes, this is an expansion to the downside, and this is going to be a retracement to the downside. This is a retracement to the downside, and let me draw a reversal. This is also going to be a reversal. Consolidation doesn't change, it's just in the same direction. It's just price moving up, down, up, down, up, down. More like it's bouncing from resistance, then support. That's the whole idea about consolidation. So these four things are the way market moves. All right, let's resume what we're doing. So right now I'll be focusing on the first one, which is the expansion. Let me rename this as a bullish expansion. So I'm going to be talking about each of them briefly. So I want you to pay rough attention to understand them. This is a bullish expansion. This is going to be a bearish expansion. Once you are able to understand these things, you will not get confused in the market anymore. You'll be able to understand what the market is doing per time. So this is a bullish expansion and this is a bearish expansion. And for there to be an expansion, from the word expansion, it means something that increase in length, more like explode, increase in length. Each of these elements of price, they have their reference points. And for an expansion, the reference point for an expansion, the reference point means like their core, what really triggers them or what really make them to come into existence. So for there to be an expansion, the reference point for an expansion now is going to be other blocks. As new traders, you know what other blocks is. So the reference point for an expansion, either in a bullish scenario or either in a bearish scenario, is order blocks. Yes, it's order blocks. So at the low of every expansion, you definitely see an order block. And what is an order block? An order block is oftentimes where order is, like in the institutional market. That point we call the order block is where price is being pushed either to the upside or to the downside, where there's a huge amount of orders. And once you have much orders at a location, definitely there will be liquidity in the market and there will be an aggressive move either to the upside or to the downside. All right, guys. So I was trying to define what an order block is, and according to Google, I'm going to paste what define order block as. And as you can see here, let me do something. Okay. So as you can see here, in Forex, an order block is a specific price zone where institutional traders or smart money place huge buy or sells orders. So that is the definition of an order block, a specific zone where institutional traders or smart money place large buy or sell orders. So for every expansion, there will be an order block located there. And for there to be an order block, you can easily identify an order block, for example, in a bullish scenario, as the last down candle before the up move. As a trader, you understand different we have two types of candlestick, which is the bullish and the bearish. So I'm going to show you how to identify a bullish expansion. In a bullish expansion where you have price going or expanding to the upside, we are going to have series of a bull candlestick, which signifies bullish. So to identify a bullish expansion, the last bearish candlestick before the series of bullish candlestick. That's what we call the order block. And same thing in the bearish expansion, we are going to be having series of bearish candlestick going to the downside. So the order block is going to be the bullish candlestick before the series of bearish candlestick. That's where we're going to be having the order block. So the bullish candle is going to be the order blocks there. Let me show you an example on the chart. So on my chart here, this white candlestick, they represent bullish, meaning price to the upside, while this a little bit dark color represents a bearish candlestick. So in this scenario now, where we have a bullish movement to the upside, you can see here price moves like this. It went up just like this thing I drew here, just like this. See, there's a similarity between them, just that this one is bigger than this one. But as you can see, before this series of bullish, I told you my green candlestick are bullish candle. So before this series of bullish candle, you can see this black candlestick here. So for me, this is my order block. This black candlestick before the aggressive movement of the bullish candlestick is going to be my order block. So you can see this series of bullish candlestick. This is an expansion for you. So this candlestick, this black one now, is, I'm going to pick it as my order block. This example one. Let me show you another example. Let me show you an example. In this scenario here, look over here, see something here. Here also we have an expansion to the outside. This is an expansion. If I bring it out right now, you see this is an expansion to the upside. It's expanded, it's increased to the upside. So in this scenario now, you can see we have series of green, and I told you my green candles are the bullish candlestick and my black ones are the bearish. So as you can see here, this was the last black candle, which is the bearish candle before this up movement. So for me now, this is going to be my order block. This black one I have here is going to be my order block because it is the last bearish candlestick before the up move. So that is my order block for an expansion. Now let's look for a bearish scenario where we have price expanding to the downside. Okay, I found one. If you look over here, we have an expansion here to the downside here. We have an expansion here. The bearish expansion. If I'm to bring this one out now, you see it's an expansion to the downside, and I carried it from here. So you can see here we had series of bearish. There's an expansion to the downside here. So for me, the last bullish candlestick, I told you my green candlestick are the bullish, while the black are the bearish. In this bearish scenario now, my green candlestick that I'm drawing out is green one. This green one here. That's my order block. As you can see, that's my order block. Let me look for another bearish scenario. If you look over here, we had an expansion here. Another way to spot out an expansion is using your line charts. That's another easiest way to spot out your expansion. So if I take this one out now, this is an expansion to the downside. This is an expansion from into the downside. So in this bearish scenario, which is to the downside now, this green candle was the last bullish candle before this down movement. So I'm going to draw it out now. So that is my order block. That green candlestick is my order block. So the green candlestick before this bearish movement is my order block. So let me type it out now so you understand. So what I've been saying is that in this bullish scenario, the last bearish candlestick before the bullish movement is my order block. So that is it in a bullish scenario. Why in a bearish scenario is going to be the reverse. Reverse is going to be the case. Let me just put it here. So here it's going to be the reverse. Yeah, a bearish is my order block. So I was typing order is my order block. Same thing here. It's my order block. So it's as simple as that. When we have price heading to the upside, the last bearish candlestick before the bullish movement is my order block. Why in a bearish scenario, the last bullish candle before the bearish momentum or bearish movement is my order block. So that is it, and I hope you understand. As you can see, I've shown you here that this in this bullish scenario, just like I said here, this bullish price going to the upside, the last bearish candlestick, which is this black one, before this aggressive move to the upside, that's my order block. And I showed you like two examples. Same thing here. You have green, and I told you my green candlestick are the bullish. So like I said, the last bearish candle before the bullish movement is my order block. So this black one, this black candlestick here, is the last bearish candlestick before this up movement. Then in the bearish scenario where price is going to the downside, the reverse is going to be the case, or the inverse is going to be the case. The last green candlestick, which is the bullish candlestick before the aggressive sell, is going to be my order block, just like I said here. So it's going to require you to like practice and open your eyes so that you can easily spot out and know the difference where your order blocks are located in a bullish scenario and in a bearish scenario. So I'm going to move to the next one now, which is the retracement. Let's get on with that. We have extensively talked about expansion, and now we're talking about the second element of price, which is retracement. So the whole idea about retracement is, first of all, retracement starts from an expansion, just like this, an expansion. Then it retraces back, meaning price just did a comeback a bit, then continued in the intended direction. So that's what retracement is all about. So price pushed up, but just retrace back just to fill in some things and continue in the same direction of the expansion. In the bearish scenario of retracement, we have an expansion here, and price did a retrace back, then continue in the intended direction. All right, the main purpose of retracement happening is when price is going back to fill in some stuff it's left behind, maybe some spaces it's left behind. That's the whole idea about retracement, because in the market everything ought to be filled. There's no room for leaving gaps, everything has to be filled and balanced. So this is a bearish retracement. I'm trying to rename it so that you can identify it. So this is a bearish retracement, this is a bullish, this is a bearish. And the reference point for a retracement to happen is what we call a fair value gap, also known as imbalance, also known as FVG, whatever the name you want to call it, it's still the same thing. So the reference point for a retracement is what we call fair value gap, and that is what price comes to do here, to tap into the fair value gap, more like to balance it. You know, in accounting, when you are doing accounting, you have to balance your book so that everything will work well and there will be no lapses. Same thing in the market. So the market is trying not to leave anything behind to balance the whole market. So that's where fair value gap comes in, and that's why you have retracement. The idea about retracement is to just come back and balance up, because whenever we have an expansion, like we have previously discussed, whenever we have an expansion, price moves so fast that it leaves some gaps along the way. So those gaps it leaves along the way is what we call fair value gap. That price comes back inside to fill up and continuing in the intended direction. So in a bullish scenario, we have price move so fast, price will now come back a bit to balance those spaces left behind, because it doesn't want to leave any imbalance and continue upward. Or in a bearish scenario, price rush down, it retraces back a bit, come back and balance, then continue in the direction. So that's the idea about retracement. Let me now show you on the chart where we have cases of price retracing. Okay, I found a very good example here. So here, like I told you, an easier way for you to be able to mark out your expansion, your retracement and the likes is for you to use your line chart on your chart or on your trading view. For here now we have an expansion to the upside. We have an expansion here. We have the retracement here, and price continued upwards. Price continued upward there. So if I'm to draw this one out, we're going to have something like this. Having something like this, because I extracted it from here, as you can see, I extracted it from here. This expansion that happened to the upside, this retracement and continuation to the upside. If I draw out the fair value gap now, you can see this candle, there was a fair value gap here. Sorry, there was a fair value gap in between this place. Can you see? There's a fair value gap here that price came back into before it continued upward. So here is the fair value gap. As you can see, price came in and went up. Let me look for another example of a retracement so that you get a better understanding. Okay. I'm looking. Okay. Okay, I found another one here. If you look over here, we had an expansion here and a retracement. This is an expansion to the upside. This is an expansion here. But what else do you notice? We had a retracement here and price continued upward. So if I'm to extract this is it. Sorry, if I'm to extract it, this is here. This move up, this move down, this move up. In between here, we had an FVG here. In between this place, we had an FVG. You can see there's this piecing in between here. So price returned into the FVG and continued in the intended direction. Let's find for a bearish scenario. We've been looking for a bullish scenario now. Let me look for a bearish. If I will get. Okay, trying to find for a bearish scenario. Okay, I think I found one. I used this one too for the expansion at that time. You can see here we had a bearish scenario price came in, continue there. If I'm to extract this one out right now, this is what it looks like. Same thing like I do, expansion, retracement, continuation. And if you look over here, we had a FVG here. We had an FVG here. So you can see when we had an impulsive move to the downside here, you can see there was a space. This long candle was that space, but you see price came in and continued in the direction of the expansion. Yeah, I hope you understand. So that is the whole idea about retracement. First of all, an expansion is created, and because of the expansion that is created, there's an fair value gap that is created, meaning the imbalance was created and left there. Then price goes back in, balance it up before continuing in the intended direction, because price doesn't want to leave any imbalance behind, so it goes, fill it in and continue. If I show you another example now, in a bullish scenario now, we had this one, an expansion happened there. You can see this expansion, price came in and continued upward. This is even recent. So if I'm to bring this one out, can you see it looks like this? An expansion, retracement, continuation upward. And if you notice, before this move back in, we had this expansion. Before this move back in, this place was the fair value gap. If I'm to do a replay now, let me see if I can do the replay. Sorry. So if I see we had the expansion, let me use this replay for you this moment. So if I do the replay now, we had this expansion previously to this side. This expansion. What will you see now? The price came back inside and went up. So it's as simple as that. Price came in like this and went up. But before price came in, we have a fair value gap for this space in between. Some other times we are going to talk about a fair value gap. For now, I'm just talking about the element of price. So in between here now, we had an FVG, which price came back inside and continuing upward. Thank you so much for your time. The next one we are going to be talking about is what we call a reversal. So we are going to be talking about reversal next. We are going to be talking about reversal now. So in a bullish scenario, this is going to be a reversal. Just don't mind this line. And in a bearish scenario, this is going to be a reversal. So this is our reversal. And the reference point for a reversal is what we are going to call liquidity pool. Liquidity pool. Or we can also call it nested FVG, which is fair value gap. So the term nested FVG means where we have two or more fair value gap connecting together. So in this scenario, we have much fair value gap and they tend to pull price because they want to get balanced. And because of this, price have to move in that direction. So normally in this scenario now, we'll have expected price to expand, do a retracement and continue in the intended direction. But in the state of reversal now, once the reversal happen, it means below this expansion or close to the expansion, not far away, we have a lot of FVG that are nested together, more like they are interconnected. Or sometimes they might not be nested, but we still have a fair value gap there. Their price want to balance, because most times fair value gap dey pull price to them because they want to get balanced, and that is why price will now come down here and balance it. And once it balanced it, it will change the direction of that market. Same thing in a bearish. Let's say market has been selling to the downside or expanded to the downside, and we're expecting maybe a retracement to the downside. But because we have like a nested FVG here or a lot of FVG or an FVG here, price will pull the FVG here will pull the price. Instead of this, you just come here and do a retracement and continue. Price will, the FVG will pull the price to itself. Let me show you an example of what I'm talking about here. Okay, I've got a perfect example here. So in this scenario, we had an expansion. Just follow me. We had an expansion here, and normally we said retracement should have come like this and go up. But what did you see here? We had the reversal here. This is a perfect example of reversal, because let me pull it out. Can you see that is the same thing with what I drew here? We had an expansion to the upside, but it got pulled back. It got attracted by an FVG here. And if you look closely here, if you look closely here, we had an FVG below that attracted. That's why I said sometimes they might not be nexted, but we have FVG that are close to that expansion that will pull it to that side. You can see there's an FVG here. So there's an FVG here. There's an FVG here. See, there's an FVG here that pull it. So it pulled it after the expansion happened. It pulled it to itself and continued downwards. Let me look for another example. Reversals. Let me look for another example if I will get. I'm looking. Let me look for another example. Okay, let me zoom out now. I'm going to see something here. Okay, let me look. Let's see something here. If you look at this scenario now, although this one is very very big, but it's a perfect example of what I'm trying to show. You see this expansion. This one also is an expansion. This is a whole lot of expansion, a very big one. So we had an expansion to the upside here, and normally for our retracement now, we'll have wanted price to just come here. For our retracement, we'll have said price should just come here and go back up, right? Normally from our retracement that we did the last time, we'll have expected price to just come in here and go up. But what happened there? Price did not come in and retrace. Instead, price did a reversal here. Why did the price do a reversal? Can you see another FVG here? That's why I said another FVG can pull it, or next FVG. Can you see here? There was an FVG below this expansion that happened here. And what did price do? Price came back. Instead of it to just come inside this first FVG here and go up, price did what? Price came into it and changed the direction of the market. So if I pull this one out now, so from what you can see here now, you can see the expansion was there, but the retracement did not happen, and we had a reversal to the downside. That's another example. Okay, I've shown you this one. Let me see if I can get another example. Let me see. The reversal doesn't happen every time. Let me see if I'll get an example. I'm trying to look for an example. I don't seem to get anyone right now. So that's the whole concept about the element of price. I can't find another example of reversal. Sorry about that. But once you just get the idea behind it, you can spot it out yourself and understand it. And the next element of price we'll be talking about is consolidation. Although I don't pay my attention to that, but just crucial, you know it also. You have consolidation. Consolidation happen when price is bouncing within a particular range, maybe just going up. A perfect example is, let's say you are in a room, price is just bouncing to the roof, bouncing to the floor or to the tiles. That's an example of what consolidation is. So it's consolidation. Consolidation. Although I don't trade consolidation, but people trade it, this consolidation. And the reference point for consolidation is equilibrium. The reference point for consolidation is equilibrium, and that's where you get to use your fib tool. It's just within a range, 50% fib level, but not much, just consolidation. And like I said, people trade it, but I do not trade it. It's risky to trade, but if you know to trade it, your choice. So So consolidation, if it's bullish, then it will be towards the upside, consolidating to the upside. Then if it's bearish, it will be consolidating to the downside. Let me look for an example of consolidation where we have consolidation. So I can show you. It just means price is ranging within a particular zone. Let me show you something here. Can you see here? This is an example of consolidation here. Can you see? Up, down, up, before it now broke down to the side. So to this area, to this extent, it was still consolidation because it went up, came down, it went up again before it broke. So this was a short-term consolidation, but still a consolidation. Let me look for another example of consolidation. Can you see this move here? This little move. This is an example of consolidation. Because price was just like in a range. And whenever we have consolidation, it means price is building up for a particular thing. This is another example of consolidation. It's an example of consolidation. It means price is building up for something. Can you see after the consolidation, there was a break above. Like this side now is like loading to either push up or to push down. Can you also see here when we had the consolidation? After a consolidation, the next thing you will see is an expansion. Can you see after this consolidation here? Expansion, aggressive one. Let me look for another example. Let me show you. Here also we had a consolidation. Here we had consolidation. Price is just going up, going down, going up, going down, going. It broke up. See, it broke down again. So that's an example of consolidation. So one thing you ought to know is that among all these elements of price will always go from consolidation to an expansion. Price doesn't go from consolidation to maybe retracement or data. No, price will go for consolidation. Price will always go from price will sorry, price will always go from consolidation to an expansion. So it's very crucial. You know that price will always go from consolidation to an expansion direct, but it will not go from consolidation to reversal or retracement. No, it will go from consolidation to expansion. So that is one thing you ought to know. So These four things I've explained, that's the only way market moves. Market doesn't do anything outside these four things I've mentioned. So, thank you for watching. That'll be all for now.